Hi, I'm Harper Jones with Life with Leverage. And we coach people on the infinite banking concept and how you can become your own banker. Today, we're going to talk about life insurance efficiency spectrum and why we use a whole life insurance contract designed specifically geared to your goals and objectives versus the other permanent products out there like Universal Life, Variable Universal Life, etc. And we will dive into the reasoning behind it, the logic behind it, etc. So let's flip over to the screen here and let's check this out. So, as you see, we have life insurance efficiency spectrum. And our main goal when designing a policy, because remember, we're designing a policy, which is like our platform or our product. And then the infinite banking concept, the strategy we coach people on, is the process. So if we're going to practice that process, we want a very strong, firm foundation, just like if you're building a house on top of that foundation, right? You want something very strong that you can rely on the rest of your life, right? Because we're using this life insurance contract as our savings vehicle, so to speak, or a place that we rely on cash or our hard-earned capital being able to be accessed when we need it for investments, to finance other things, our taxes, or anything of that nature. So when we're designing it, our main focus is to keep all the growth within the policy tax-free and without restriction. So you have complete and total freedom. Whereas, say, a 401k or a Roth IRA or self directed, any of those other qualified plans, because life insurance doesn't fall under a qualified plan or government sponsored plan, it is allowing you to have all the freedom, no restriction of waiting till 59 and a half. It's much easier to tap into the cash and use it in a tax-free manner if handled properly. With that said, let's look at some acronyms of some words we're going to be using today. So when I say one pay, I'm referencing a one-time premium payment. When I say PUA, I'm referencing what's called a paid up additions rider or PUA premium. Could be called something slightly different depending on the insurance carrier. DB stands for death benefit. Whole life is the whole life insurance policy, which falls under the permanent umbrella of insurance products. You got whole life, and then you have another one, UL, which would be universal life insurance, VUL, variable universal life insurance, IUL, index universal life insurance. Then you got a term called a MEC, which is modified endowment contract. And keep in mind, think of it as like you have a house that has a 10-foot ceiling, for an example. We can't cross that 10-foot ceiling. Otherwise, we would MEC the contract, or we would break past a threshold, so to speak. And then that would essentially make our life insurance contract treated like a qualified plan. And we won't have as much freedom, and we would have some restrictions, and there would be some taxability, which we don't want. So we'll stay within that. And then QP would be qualified plan. So as we look at the life insurance efficiency spectrum, you'll see the least efficient off to the right side and the most efficient on the left side. By least and most efficient, we're focusing on cash value accumulation without giving up any cracks in that foundation, so to speak. So when you are looking at policies that are designed on the internet or by other people, there will be a handful of people that will design life insurance contract more in what's called like a 1090, which means they'll be very top heavy on cash value accumulation in the first few years, and then much less premium that you can contribute or cash you can contribute to your life insurance policies later on in the policy. And that's going to have a little bit more cracks in that foundation, even though you could get some more cash value accumulation. You just got to be careful with that. We can dive into that another time. I'll do a video about that. So when we go to least efficient, you would have what's called term insurance. So you pay a premium, usually pretty cheap, for a lot of death benefit for a term. And say that term's 10 years, 15 years, 20 years, or 30 years. You'd pay $1 in, you'd have $0 in cash you could access or cash value or equity in the policy. You'd have a lot of death benefit. I'm not saying don't have term to make sure you're protected and covered, but just know it's not good for a strategy for infinite banking because there's no cash value accumulation. Most efficient is what's called a one pay. And this one pay policy would be like a single premium policy. So let's say you had $1 million, you could put it into a life insurance contract, and then you would be able to get maybe close to $1 million in cash value, maybe 850, 900K or more. And then you'd have maybe 1.5, 2 million in death benefit, and it's all paid up, so to speak. No more premiums required, but all the cash in there will keep growing for you, and you can borrow against it. Well, they had a ruling called the Modified Endowment Contract ruling that went into effect in 1986. And in 1986, they said, hey, you're not treating insurance or life insurance like insurance. You're treating it a little bit too much like, hey, just placing money there, more like an investment, so to speak. So the IRS stepped in. They said, hey, no more of that. We got to spread out how you get cash in there. And that's what they did. So now we can't do the one pay, even though it's the most cash efficient for you. And we have this threshold, right, which is like a MEC, that modified endowment contract, that ceiling. Anything past that would be treated like qualified plan, where you have some restrictions and you're going to lose some of the tax freeness. Then you have a whole life insurance contract, which is the basic run of the mill whole life contract. It is going to have cash value accumulation, but it's going to take a little while to get there. And so what we like to do is use a rider, just like in any insurance product out there. Say with a house property insurance, you could have flood insurance rider, or with car, you could have a different type of rider you add onto your policy. Life insurance is no different. There's a handful of different riders. One we're using all the time is what's called a paid up additions rider. And essentially it acts like that one pay policy where you put in $1 and you get about $1 in cash value accumulation. And so the blend that we like is to put a chunk into the whole life premium and a chunk into the paid up additions premium in the beginning years to essentially overfund or accelerate that policy. Now, these more exotic products that haven't been around as long, because whole life's been around for a long time, like over 100 years. Well, universal life, variable universal life, index universal life, it's more so tied to the market, or you would have a component where some of the cash is accumulating and some of the cash in that policy, and like universal life, would be used for paying for the insurance, right? So they kind of separate the two within the contract, so to speak. Well, we don't want that because it's not consistent, it's not reliable, it's tied to what the cost of insurance could be later on in life, it's tied to the market potentially in some of these products, and this is more of our savings vehicle, or where we're going to warehouse our capital, and then we're able to leverage against that for our investments. So we don't want to tie this firm foundation to something that could be cracked, in the future, right? So we decide not to use those products, even though they might be slightly more cash efficient from time to time, or projected to be that cash efficient. And I'll do another video on why we don't like universal life or variable universal life for this strategy for infinite banking. And I'll compare the two, whole life versus universal life. So whole life here, we would get about 40% of the premium that we would pay in a given year to the whole life portion. We do about 60% of the given premium to the paid up additions portion. Sometimes we'll do a little bit higher paid up additions, sometimes a little bit less. Once again, depends on your goals and your objectives and where your MEC or threshold will lay. Now let me go back here for a second, recap. So with the whole life base premium and the paid up additions rider, we're able to bump up against that MEC or that ceiling, so to speak, get you as cash efficient as we can without trading off any cracks in the foundation. So we have a firm foundation long term. And sometimes we might have to use what's called a term rider to get us a little bit more cash in there. But we just don't like to use a big term rider to try to get way too much cash in the beginning, because that goes back to giving you a little bit of a shaky foundation. So I hope this helps. If anyone has any questions or wants me to elaborate on this, or why we design this way, why we go about it this way, really comes from Nelson Nash and his book, Becoming Your Own Banker. We do tweak a few things off that, depending, once again, on people's goals and objectives. You can reach out to me at harper@lifewithleverage.com, or you could go to lifewithleverage.com and schedule a call. Looking forward to hearing from you. Thanks.